narrative of what the market is doing. Like I said, like the narrative of this is that price breached liquidity. So if we go back, let's see where it breached liquidity, and then let's talk about why these are now bullish order blocks and can be used as a trade, right? So get all this stuff off the chart. Goodness, I know I'm gonna go full time. Goodness gracious. We take all this stuff off the chart, right? We see liquidity here, price breached it, right? Traded past it, then traded past it a little bit more. Now, at that point, and you see price begin to turn back the other way, you're seeing similar pricing in the DXY, meaning that it's reciprocal, not similar, but it's reciprocal pricing, meaning that the price is trading the opposite way of this chart. Then you have confirmation that at least price is going to make a run back towards either a fair value gap, and most likely you're going to be targeting a fair value gap if you're going opposite of the major buyers or the major higher time frame buyers or higher time frame trend, right? You're not going to want to target liquidity over up here because most likely price isn't going to reach all the way up there if you're taking, counter trend trades, right? And we'll go over a strategy to take counter trend trades with what you know as the head and shoulders. It's similar to a concept that ICT uses that I can't really talk about, but I can talk about the head and shoulders, so I'll kind of explain to you why the head and shoulders should be used as a reversal pattern in certain contexts and within a certain higher time frame bias. But anyways, so once we know that liquidity has been breached, that is the context that we need to be able to then take bullish order blocks and use them as trades, knowing that we're really scalping. We're not really trying to get liquidity up here, because what we know is going to happen is price is eventually going to want to come back down after it reaches into whatever fair value gap or whatever liquidity that it has breached in the counter trend, right? In the opposite way of the higher time frame bias, right? So when we talk higher time frame bias, it's obvious. This thing is sliding. And you can tell with reciprocal pricing in the DXY, if we're looking at the DXY, you can tell that the DXY is going up. So naturally, foreign currency should be going down. Take that down in your notes. You should know that. You can use the DXY as a true real-time indicator, and I'll go over that in another video. But the DXY is a true real-time indicator for the market. So if the DXY is going up, you have confidence that if you're taking a sell trade in foreign currency that has the US dollar pegged to it, so a GBP USD, Euro USD, AUD USD, you can bet on the fact that the market in those foreign currencies will probably go down, right? We're looking at what can be an issue when you're using the order block finder, and that's one of the main things, is that you have to understand the higher time frame bias. If you don't, then you could be looking at this indicator like you do all these other indicators, and that's why I don't use indicators. You don't need them when you're trading smart money concepts or you're trading ICT's work, because you have the real-time indicators in the market. The DXY is the only real-time indicator that I need. Fair value gaps, whether or not they're being traded past 50% or not, order blocks, breakers, all the things that ICT calls PB arrays, these things that help you really understand the market. Why would I even need an indicator when I can use those things that are giving me the real-time indicator so that I can be on the right side of the market so that my family can eat? You know what I'm saying? So you have to be careful with indicators, especially something like an order block finder. You're thinking you're using smart money concepts. You have to understand the bias. Now, if you understand the higher time frame bias, and you understand that you're really trying to be looking for sells in a market like this, like even when you back up, right? And we go to what I had shown y'all before, right? In a previous video, I had shown y'all how price had breached liquidity and had come all the way down here. Then it came back up. So let's talk about that real quick. Goodness gracious, these order blocks are everywhere. Price had breached some liquidity over there, came all the way down here, traded back up, breached a little bit of liquidity right here, but ultimately just traded into what was the fair value gap. So let's kind of zoom in on that. Ultimately just traded into what was the fair value gap right here. Did not trade past it, filled it in, correct? and then what happened? Traded back the other way. So you're really looking this whole time as it's coming up, you're probably taking a break. You can take some of these trades, right? If you're seeing that prices are respecting breakers, that's a breaker right there. Low, high, lower low. All right, let's just zoom into this area. Low, high, lower low. The highest up close candle, use that candle as the breaker, reach it across, and guess what? Price doesn't fill in. Look at it. We're at the bottom of this breaker, this bottom candle right here. Price doesn't fill it in, it continues to trade up. Also, what do you have? Fair value gap. Price just barely passes it but respects it and then begins back to trade up. You can take that trade in a counter trend trade, right? Like these are order blocks. Bullish order block, 1, 2, price trades back down into it. Fair value gap right here. If you see it, it's a little small fair value gap right there. Boom, price trade. Like you can take those trades, but you got to know what you're doing. You can't be in here trying to use order blocks in different directions, you know, each and every day, one day after the next. You're using bullish and then you're using bearish. Like you want to keep yourself on the right side of the market, okay?